Watto, Matt from the past, back with more trivia time, and here it is. Black Thursday, as Thursday, October the 24th, 2024 came to be known, was the first day of the stock market crash of 1929, a catastrophic decline in the stock market of the United States that immediately preceded the worldwide Great Depression. That stock market crash, also called the Great Crash, is still considered the worst one in history. After share prices on the New York Stock Exchange, which have been trending upwards for almost a decade, dropped 4.6% on Wednesday, October 23rd, nearly 12.9 million shares were traded the next day, exceeding the previous record number of trades in a single day by almost 4 million. Stockbrokers were with telephones and ticker tape could not keep up with the extraordinary volume of trades requested from shareholders, resulting in delayed and incorrect reports which exasperated widespread panic and confusion. Police were dispatched to the New York Stock Exchange to quell potential rioting, while Wall Street executives tried to reassure the public. The Roaring Twenties, as the 1920s had been known, was a time of consumer optimism and significant technological advances that had produced an extended bull market in which the prices of securities and commodities had risen consistently. This led to rampant speculation or speculative trading as millions of people purchased shares on the assumption that continued price increases would enable them to turn quick profits on their investments. Despite the bull market, however, some economists began voicing their concerns about the potential for a crash months before what would quickly become known as Black Thursday. Many of the stocks being traded have been purchased on margin, that is, with a cash payment representing only a small fraction of the stock's actual value, the rest of the purchase price being covered by a loan from the stockbroker or investment company, with the stocks themselves serving as collateral. In addition, the increased demand for American manufactured goods in the years immediately following World War I had eventually led to overproduction in various sectors, causing many businesses to lose money and their stock prices to fall. As Black Thursday unfolded, several major banks and investment companies bought up great blocks of stock in a briefly successful effort to stem the panic of investors. At the end of the day, the market closed only a few percentage points down, and on Friday it recovered very slightly. Wall Street's calculated show of confidence ultimately failed, however, as nervous investors resumed selling stock the following Monday and Tuesday, later known as Black Monday and Black Tuesday, when prices declined by a further 12.8% and 12% respectively. The panic could not be stopped. As stocks declined in value, brokers and investment companies for stocks sold on margin required more money from buyers to compensate for the loss of collateral, and buyers themselves raced to sell stocks to minimize their losses. Black Tuesday is generally considered the last day of the stock market crash of 1929. The Dow Jones Industrial Average had reached a high of 381 points on September 3rd, 1929. After the crash, the market continued to decline, and by July 1932, the Dow had fallen to a low of 41, an 89% drop from its zenith. The stock market did not revisit the highs seen before Black Thursday until decades later in November 1954. In addition to costing investors and businesses millions of dollars, the crash beginning on Black Thursday undermined consumer confidence. The sensational nature of the crash served as a cautionary tale, and consumers and business spending slumped, especially for items that were generally purchased on credit, such as automobiles. The reduction in consumer spending and the ensuing contraction of industry led indirectly to declines in manufacturing and employment. Although the stock market crash of 1929 resulted in significant harm to the U.S. economy, economists still disagree about how directly related it was to the Great Depression. Was the crash a symptom of an already ailing economy that would soon collapse, or was it the direct cause of the Great Depression? The debate goes on to this day. In 1932, the U.S. Senate Banking and Commerce Committee convened, and the Pecora Commission, named after the committee's chief counsel, Ferdinand Pecora, to investigate the crash and to recommend steps to prevent a recurrence. The investigation led to the adoption of the Securities Exchange Act of 1934, which created the U.S. Securities and Exchange Commission, an independent federal agency that oversees stock markets. And that was today's trivia time, and now let's get back to the show.